What is up, everybody, and welcome back to the Fresh Finance Podcast. My name is Thomas Elms. I've got my co-host here, Kyle Ryan, as always, and today we are going to dive into insurance planning. And as we're shooting this, Kyle, right around the holiday season, but we're also in the middle or towards the end of the open enrollment period as well for a lot of W-2 employees, company benefits election years. So this is a pretty common topic. I've had a lot of conversations about this here recently, but we just felt it was important to talk about because, for the most part, at least in my experience, and Kyle, I'd love to get your take on this. For the most part, about everyone is underinsured in some degree, in some specific fashion of their life, and we kind of came up with this three-part component to full insurance coverage that we broke it down into health, wealth, and income. So when you're looking at insurance protection or insurance planning, you're trying to protect your health, you're trying to protect your wealth, and you're trying to protect your income. So we're going to kind of dive into that. But Kyle, before we get started, I'd love to get your take on this topic and that comment I made here a second ago.
Yeah, I think you're spot on. The good news with all these insurances is they are, and a lot of the times, from a financial advisor's perspective, necessities, if you will, good protections to have. But the good news is most of these are already taken care of, whether they're required or whether they're offered to your typical W-2 employee through work,
Yeah.
which we'll get into each of those. But yeah, for the most part, a lot of the people that I see have these. But like you said, I very rarely come across someone who is overinsured in every single one of these, unless they have gone out on a quest to do exactly that.
Yeah. Yeah. And I think the other thing too for today's episode, what we're really trying to accomplish is just kind of the 30,000-foot view of each type of insurance and, walk through some things to consider, because I think a lot of this is finding somebody who's an expert in that topic area and utilizing them to figure out what policy is best for you, because just to kind of get started, right? Health, wealth, income, the three different types of insurance protections that we're looking at taking advantage of. When it comes to your health, we're looking at the things that are normally offered upfront as a W-2 employee by your company, right? So your medical, your vision, and your dental insurance, right? You're using those things to be preventative in screening your eyes, your teeth, and just your overall body, bodily health. And I think one of the big things there on the medical side is evaluating where you're at from an age standpoint, from a number of visits per year standpoint, and just from an overall health cost standpoint. And what I mean by that is and I kind of had this trajectory is when you first get out of college, first start your job, you're probably pretty young, you're probably pretty healthy, right? In that instance, you're normally not needing to go to the doctor's office very often. You're normally not needing a lot of medical costs to be covered by a more comprehensive insurance coverage. And so looking at something like a high deductible health plan and having the ability to contribute to an HSA at a young age is, in most circumstances, or in some circumstances, the most ideal option, right? Because the thing that you're constantly weighing on the medical, vision, and the dental is how much premium you're paying versus how much deductibles you have to meet. And so I think you're just constantly in this situation of the older I get, the more comprehensive of coverage I need. That's in a normal kind of life and health trajectory standpoint. But you also want to figure out kind of what that sweet spot is for you, and also what's specific to your individual plan. Because I'll tell you, I don't know about you, but I've looked at probably 15 different health insurance plans over the last month. And I swear every single one of them slightly different.
Oh yeah. Oh yeah. And I'm sure they're regional too.
Yeah, they're regional. And that's even, within the same company, right? I'm just throwing out a name that comes to mind, but like a United Healthcare. It's like, I've looked at three different United Healthcare plans and all three of them look somewhat different. And so just kind of evaluating what your employer is offering. And the other thing too, is I've got a client who's a W-2 employee, but to be completely honest, she's married. Her health insurance, from being just the employee being covered to the employee and the spouse, the dollar amount jump to covering the extra spouse is astronomical. We're even evaluating the option of getting her own insurance, right? It might technically be cheaper that way as well. And that's where you can save hundreds of dollars a month depending on that plan. So the reality is on the health side is really just making sure that you're outlining and weighing what is best for you at that point in time. And, obviously trying to figure out what that trajectory looks like for you, and going forward. Do you have any thoughts on the health side?
I think you covered it really well. I would say one thing for the W-2 employees out there, if your company's offering you health insurance through work, what they're usually going to do is you're kind of getting like a group rate. It's not what
Yep.
if you were going to go and seek individual coverage just on yourself and get underwritten based on your unique attributes, the price that you pay would likely be different than what you get through work, because what they're doing is I think they look at two criteria. It's your gender and your age. And they're going to say, okay, well, you fit in this bracket. This is what everyone else around you is paying
Yep.
for this company. This is what you pay.
Yep.
So if you're a really healthy individual and you're surrounded by people who might not be very healthy at work, you could be paying for their increased cost.
Mhm.
Whereas if it's vice versa and you're very unhealthy and you need, specialized medicine and whatnot, you might be better off having that coverage through work than you would be if you were to go out and get it on your own.
Yeah. And I think the reality too is as you're adding a spouse, if they need health insurance coverage, if you're adding children, if they need health insurance coverage, normally, I'm saying normally, the company provided insurance route is going to be cheaper because they're also paying premiums too. A lot of people don't recognize that is your employer is paying insurance premiums for you as well. So your insurance coverage is not technically all in what you're just paying. So that's important. When it comes to the wealth component, this is protecting assets, protecting the wealth that you've built out. We're going to kind of divide this wealth category into what I would call kind of two different segments. So for me, I'll talk real quick on home, auto, and umbrella insurance coverages for some of your assets and possibly even liabilities. We'll talk about cars here as well. And then Kyle, I'd love to have you talk about life and long-term care insurance. This is probably the space where I see people underinsured the most is home, auto, and umbrella insurance. I cannot tell you how many times I have worked with a property and casualty insurance agent that helps me with a lot of the cases that I work with. And they basically work with him, get all their deck pages and walk through all their insurance coverages that they currently have. And they have state sponsored minimum coverage, especially on the auto side of things. And normally that is the case because they had to get some policy after they moved out of mom and dad's house, or if they got married and they grew their wealth after that, and they haven't adjusted their insurance coverage. There's so much liability in that because if anybody's ever been in a car accident, known anybody that's ever been in a car accident, or had somewhat serious hospital bills, or had a big crash in a car, those things are so astronomically expensive. So it may sound crazy to have, $150,000, split dollar policy for your car insurance to cover bodily injury, right? There's just so much that goes on there that a lot of people don't take into consideration. And once you've maxed out your insurance coverage, guess what it's on? That excess cost, that's coming out of your checking accounts, coming out of your assets. And, as you build wealth, you're also a target for being sued, right? Being sued for heavier. And normally they're going to look at what your assets look like to determine what is a fair amount to file that suit for. So having these coverages to protect your cars if you're driving, especially underinsured motorists or uninsured motorists, that's something to really take into consideration. And then on the home side, making sure that you've got all the right, riders and adjustments to your policy, especially based off your geographical, location. The umbrella piece is so nice too, because you can get so much umbrella coverage, which is kind of like that secondary barrier after the insurance has paid out everything it can pay out. You can get so much coverage for really cheap in most cases.
Yeah, umbrellas really nice to have if you have a home to get it against. Really it's cheaper coverage usually for a nice huge dollar amount. Usually $1 million would cost you, I don't know, it's like $10-20 a month or something like that.
Yeah.
The auto insurance is so important to get the proper coverage in, because I mean, Thomas, you and I, we individually know someone who got into an auto accident and then later discovered that they didn't have the proper insurance. And I
Yep.
remember right after that, I had an attorney, a personal injury attorney, look at my coverage because when I first got my car insurance, I was like cheapest possible everything, save me money. Without
Yep.
realizing on the back end it could cost me. So, like you mentioned, the uninsured or underinsured motorist, if you just have the state minimum coverages and you get into a serious accident and the person across from you either caused or got hit, whatever it is, if they don't have the right insurance, like Thomas said, you could be footing the bill.
Yep.
And homeowners insurance is always good to review, and that ties along with the umbrella, like you mentioned.
Mhm. Yeah. Yeah. What's your take on the life and the long-term care?
Yeah, life is really interesting, right? Because life can take on a lot of different shapes and sizes, right? So I'll break it down this way. First, you have permanent insurance, and then you have what's called term insurance, right? Permanent insurance is like your whole life policy, your universal life. It usually will cost you a lot more because you get to build up cash value. You can take loans against it. Very seldom, in my experience, have I recommended whole life coverage. It's usually for estate planning or liquidity purposes.
Mhm.
Um, on the other end, this is really where I want to stick with is the term insurance. Term insurance is bang for buck insurance. You are paying only for insurance. You're not investing in the account. There's no loan provisions. And there's different riders you could add on, right? So say I get a term insurance policy for 20 years for $1 million. And I'm getting close to that end of the 20 years. Maybe, in that time, my health has suffered a little bit, and I don't think I'm going to be able to get another term insurance policy. I might be able to convert that policy into a whole life policy.
Yep.
So there's some pretty unique things to do with insurance, and they also tie in like with annuities pretty well. So if you're going down that guaranteed route with whole life and annuities, but insurance, straight, just there's two types of insurance: permanent, term. Term is usually what we kind of lean toward. It's just bang for buck, right? We're not here to make money off insurance. We're just trying to meet people's protection. On the other end of it is kind of determining, okay, well, now I know what type of insurance I want. How much do I need? Right. And that's a serious question. There's a lot of different ways to go about finding that number. There's no one size fits all approach. You can look at it and say, okay, well, if I passed away, I'm 50 years old, I've got two kids, my wife living at home. If I pass away, I don't want them to have any debt. So you might look at all your debts, everything, look at how much your mortgage is, any other sort of loans you might have, and say, okay, well, that's the amount that I want to get in coverage because I want them to be debt free after my passing.
Hmm.
You have a debt pay down amount. You could have an income replacement amount. All right. So say I'm 50 years old and I expect to work for another 10, 15 years. How much income am I going to make in that time? And what's the present value of that money today to determine how much basically it costs to replace my ability to make income?
Yep.
And then there's other reasons, if you want to leave behind a legacy, life insurance can be a pretty nifty way of doing that, right? So say you buy, just throwing a number out there, a $5 million policy that is more than enough to meet your coverages, but you want a tax-free way to pass off assets to your beneficiaries. It's another way that life insurance can be pretty valuable. It's another one of those things that's offered through work. But when people have life insurance through work, sometimes they'll always want to cost compare what it would be like to get it on the outside because there's what's called portability to life insurance and especially disability and anything else offered at work. If you're no longer working there, you may no longer have access to that type of insurance. Now, health, medical, that's covered by COBRA rules and laws. But for life insurance and disability insurance, after a certain amount of time, you might lose access to that and you might no longer be insurable if you get let go by a job or whatever reason. So looking at outside policies and comparing them to the cost of what you have at work, because at work you might have like a 2 to 5x times your salary sort of thing. So just understanding what the cost of your coverage is and seeing if you can get it elsewhere, it's really beneficial. But life insurance is, we deal with life insurance all the time. First license I got. Um, long-term care. Any other additions on life insurance you want to
No,
add?
I think you covered it well. And I think the big thing there, kind of end of the day, is figure out what your true desire is from a life insurance coverage. What do you want it to handle? And I think you really nailed it. Is do you want it? I kind of break it down into a couple different ways. Do you want to cover your funeral costs? This is normally for elderly people. My grandma, in fact, that's what she wanted. Is she wanted her life insurance coverage to cover the funeral and all of those things. Do you want to pay off all debts? Do you want to pay off all debts and provide income replacement where the surviving spouse no longer needs to work? Right. And I'll tell you, just like in my personal opinion, the way I view life insurance is with, my spouse, if we're married and have a child or children, if I pass away tomorrow, I do not want her to work a day after that. Right. If she passes away, I do not want to work myself a day after that. That's the way that I and we view life insurance coverage. There are people that are not like that, right? Because that comes with costs. That comes with increased premiums because I have to buy larger death benefit coverage in order to do so. But it's the way that I want it. Some people are a lot different. They don't want to pay that monthly or annual fee for the life insurance, and they're just comfortable with doing something that's a little bit cheaper that might just cover the debts. The only other thing I'd say is just be really careful with company provided life insurance. Like you said, it's not portable for the most part. And they normally offer very small dollar amounts. So it's either, your basic $50,000 term life insurance policy, or maybe it's a 1 to 5 multiple of your salary. So, you got a 2 multiple and you make $100,000 a year, that's 200,000 in coverage. That's something that you just got to be aware of. Because what I've found is a lot of people think their group life insurance is more than it actually is.
Yes.
And then they're underfunded, and it's something to take a look at.
Yeah, like all these different types of insurances, the end result is, especially with life insurance, your death benefit is you're ultimately going to seek a death benefit that provides the purpose with which you're getting the life insurance for, right?
Yep.
So that's always where we start when someone says, "I want life insurance." Why? Right? Nothing wrong. Like now that you want life insurance, just want to understand why so we can figure out the right amount.
Yep. Yeah.
So
100%.
moving on to long-term care. Long-term care can be as simple or as complex as you want it to be. Once you look at it on the surface, it seems pretty simple. You get into the weeds and get a little bit more complex. But essentially, what you're ensuring is the need to have skilled nursing care of some sort for X portion of your life,
Yep.
right? So I'll start off with this because I want to make a clear distinction here. It's really interesting with long-term care insurance because there's certain people that it seems to be meant for more so than other people. If you have really low income and a small amount of assets, you're more likely to qualify for Medicaid. Okay, Medicaid is Medicare's sister program for people with low income or low asset base that qualify for it. In which case, if you don't really have a lot of money, you don't really have any income, you can't pay for long-term care and you become medically disabled, Medicaid can kick in, and through certain facilities, you can go to a Medicaid approved facility to get nursing care. That's one end of the scale. On the other end of the scale, long-term care insurance for the ultra wealthy, more often than not, I see can have the ability to self-insure. Now, this is probably, I don't want to say the most expensive type of insurance, but it could be, without having it, it could be one of the most long-term, costly
Yep.
insurances not to have. Why? Because, well, look, if your home burned down one day, that would be costly if you didn't have homeowners insurance. But if you have a mortgage, it's a requirement. And when you pay off your mortgage, I hope you don't get rid of it.
Yeah.
But long-term care, if you don't have any sort of, like, we've got a client right now paying $4,000 a week for his wife to be in a long-term care facility because she was diagnosed with cancer last year. She can't take care of herself.
Yep.
He didn't have the ability to take care of her at home. She's getting skilled nursing care. That is not cheap. And the costs of long-term care are exponentially increasing as we move through time because, one, people are living longer and the facility and the type of treatment they need is getting more and more specialized and skilled. So the nurses and the doctors are requiring higher pay. So you're just seeing premiums on these really increase. So going back, where does it really fit the right type of person, in my opinion, is kind of that middle income, middle asset level type of person who, if you had a serious event to you or your spouses or your child's, whatever it is, health, it's going to impact them for a long time. This could be a serious wealth drainer in an already precarious situation emotionally, because you have someone who's either getting care at home, getting care in a facility, and it's just costing an arm and a leg. So you can either, bear the risk of that yourself, or you can get a long-term care policy. But at the end of the day, long-term care policies are, like I mentioned, just incredibly expensive too. So this is something that, you're interested in protecting yourself against, because it does happen, unfortunately. It's better to get ahead of it. I usually say in your late 50s, early 60s, because you don't want to really pay for a policy for too long, because again,
Yep.
it's very expensive. And you don't want to get it too late because you might be uninsurable at that point.
Yeah. 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 And kind of just outlining it, normally long-term care is going to kick in once you are unable to do at least 2 of the 6 activities of daily living We don't need to dive into the specifics of that, but that's just kind of an explanation into how the insurance coverage actually starts. That's normally like bathing, eating, cooking, things of that, and cleaning, things of that nature. So, one of the things too, I think is really important is regionally looking at what the average cost per month is for any sort of skilled nursing, whether that's in-home nursing care, which is normally a little bit cheaper, versus staying at an actual facility, which is normally going to be your most expensive route. I've seen these numbers vary tremendously, anywhere from a couple $1,000s a month to twelve to $15,000 a month. This is a very expensive aspect to the insuring part of your life, especially at the back end of your life. And I think the question you want to ask yourself is, do you want to deal with the burden of that payment every month, or do you want to pass that risk and that burden off onto an insurance carrier and pay premiums in order to have that type of coverage? Because once you do enter the long-term care phase where premiums are actually being paid out, you normally don't actually have to pay anything. So I think that's something that's important to recognize as well. But overall, it's definitely something important to consider, but I think you made a really great point from a cost perspective. You really need to evaluate what's best for you.
Yep. I really like the point you mentioned about looking regionally, because some, and there's also the people, professions out there exist. It's like skilled nursing facility placement specialists. Like we have someone that we talk to where if someone's going into a private living facility, and they, specialized living facility, she'll walk through them. She'll go through, hey, these are all the different ones that are available to you. This is what this one's known for, pros and cons, XYZ. So if you're going through that, try and find some specialists in the region that is familiar with all the ones local to you that can help you out. It could be a really good resource.
Yeah. Yeah, 100%.
All right, so moving on, last but not least, on the income protection side, we have disability insurance. Disability insurance I find to be just absolutely important, because there's really two components of it. It's short and long-term disability. Short-term disability will typically cover you for up to 180 days, just about half a year. Long-term disability can kick in before that. I usually see it as early as 90 days, but more often than not, 180 or up to a year, which means your short-term disability will pay you as long as its period is, up to like 180 days. And then what happens is your short-term disability kicks in after about 90 days, 180 days, 365 days, depends what you pick in terms of the elimination period.
Yeah.
So short and long-term disability, what does it do? It protects your income if you become disabled. Again, if you are a W-2 employee, sometimes, not all the times, but you'll have this offer through you to work. One really important note on that, if you're going to pay for long-term disability coverage through work, more often than not, I recommend people consider paying for it after tax. So we were talking about open enrollment. This is the time where if you have long-term disability available to you, whether or not you elect to pay for it or not. And then even beyond that, whether or not you want to pay for it pre-tax or post-tax. And why is that important? It's like an IRA or a Roth. If you take the tax deduction for your premiums for your disability policy, that means that if you get disabled and you're getting paid out, you got to pay tax on that money. Now, usually disability policies will cover you up to like 70% of your income.
Yep.
So pretend you're making 100 grand and you go down to 70 grand.
Mm-hmm.
You're already taking a haircut from your income. Do you want to pay taxes on that income, or would you rather just get it tax free? So if you pay for your disability premiums after tax, don't get a tax deduction. That means that if you ever do become disabled, that you will receive your benefits tax free, which I would rather lose out on a little bit of a tax deduction today while I'm working and making more money than have less if I ever became disabled, right? Because the marginal difference today for me, whereas it would be a massive difference for me on the back end.
Yeah.
And even taking that, a step further, if you do have short and long-term disability, right? I was mentioning if your short-term disability pays you for 180 days, one good way to line up, so saying you can either get in for your long-term, you can either get in 90, 180 days or 365 days for when it kicks in. I usually like to coordinate them, right? If I have a short and long-term disability policy, ideally my short-term disability goes like 180 days and my long-term disability kicks in after 180 days. And it picks up that way. So, and then long-term disability, usually that'll last until you're age 65. So if you get disabled, say you're 50, That'll kick in until you're 65. And then what it does is it switches over to Social Security disability income.
Yep.
So it's pretty interesting, and this is one of the biggest shortfalls in protection, I would say I see. Either people are really underinsured, don't quite have a lot of coverage, or they have zero coverage at all. On the short story side, my dad had an incident in which now he's disabled and can't work, did not have disability insurance. And all of a sudden you're on Social Security disability and your life gets turned on its head and you got to change some things. So it's one of those things that, you never want to picture yourself in that situation, but it happens. More people get disabled than they prematurely die before their retirement age. So it's something really to protect against. And I don't want to say it's cheap. It's not one of the cheapest types of insurance, but it's definitely less expensive than like a long-term care policy would be. And it's a coverage that comes into play a lot more often than a premature death would, for example. So especially if you start to have kids, you get married, it's just a good way to protect your income.
Yeah. Yeah. And I think to, I always tell people, make sure and evaluate what your thought process is on an emergency fund in conjunction with your short and long-term disability. Because I think that's something to definitely have into consideration of how much cash you're stashing away. If your income were to go away, are you considering that cash for only if you were to get fired or to get laid off? Or if you were wanting to maybe go start a second thing on your own, or if you're just maybe looking to take some almost like a sabbatical, like some time off, versus are you looking at your emergency fund as something of an income replacement if you're injured, right? Because if you have a great short and long-term disability policy, you might not actually need as much emergency fund as you previously expected. I think that's one thing to recognize. I think the other thing to recognize as well overall is, for the most part, when I've evaluated company provided short and long-term disability, it's normally very inefficient if it costs anything. I've seen a lot of companies actually provide short-term disability at no cost to the employee. So it's just something where you can just kind of, cross that T and dot that I that you have that coverage. But I think the other thing too is just making sure you're looking at those percentages, right? Because I've seen some that's company provided, but it's only like 30% of your income, right? So if you just thought you had short-term disability coverage and then you actually incurred a disability and only had 30% income coverage, that's really not gonna, push the needle as much as you thought it would. A lot of people do think that short and long-term disability provides 100% coverage of income, and that's just not the case. The other thing that I was going to say, especially when it comes to long-term disability, because you said that your father's on Social Security disability, which is interesting because I looked at a stat the other day. Roughly 70% of people who file an application to receive Social Security disability are rejected. They're rejected and denied. I think that's something really important to open your eyes up to, and the fact that you can't just rely on Social Security disability. 70% of people don't actually make it. And my question is, if you're 30 to 40 years old, let's just take a hypothetical person here, 30 to 40 years old, you're planning on retiring at 65, right? Let's put it right in the middle, put it at 35. Okay. Let's say you were to either get in a work or non-work related injury that is going to prevent you from working forever, right? And let's say you are the sole income earner. That means you can no longer work, and for 30 years, if you don't have long-term disability, you're not going to have any sort of income replacement.
Yep.
I think that's just the story you got to tell yourself. You got to recognize all the different possible scenarios. Do you think that you could provide adequately, or in an ideal situation, what you wanted to for your family in that situation without long-term disability insurance, or just make ends meet? I think that's the real question.
Yeah, it could take a hold of your life if you're not properly planned for it. And then one other note that I wanted to add to it, I almost forgot, is one of the really important things with disability insurance that they allow you to choose is whether or not you want to provide coverage for your own occupation or any occupation.
Yep.
I recently went through this with a doctor. Is if I get disabled and I'm a financial advisor and I lose the ability to speak and hear, I don't know, and see, whatever. I can't speak and hear. I can't do my job. And I have any regular occupation. So any or regular occupation is sometimes what it's called. If I can't do my job, my own occupation, then I will be covered no matter what, as opposed to, oh, well, you can go flip burgers, you're still able to work.
Yep.
So there's a difference. So there's one rider that says, okay, if you can't perform your specific job, you're covered. There's
Yep.
another one that's less expensive that says if you can work in any capacity, you're not getting paid. So that's a really important distinction. And then taking that a step further is your occupation is very important to determine how much you will pay, because they'll rate your occupation and how likely you are to get injured. So if you're a mechanic, you're probably going to pay a heck of a lot higher than a doctor would, who's one of the higher classifications, or some sort of white collar employee, because they're just much less likely to get injured at work. They're naturally going to have lower premiums.
Yep. Yeah. I think the last component to this on the short and long-term disability is business owners normally get screwed a little bit when it comes to short and long-term disability. I'll say that. I've worked through this in multiple cases, but I've found a couple of ways where it is good. Is normally when these insurance carriers are underwriting these policies, they're looking at a business owner's net income and not their gross income. And it drives me crazy that this is the case, but it will prevent you from receiving the coverage that you're looking for in most circumstances. Because if you think about it, let's just throw some crazy random numbers out here. Let's say that a business owner's, doing $300,000 a year in revenue, but their net income is only 75,000 after expenses and, any sort of additional costs. You're getting, let's call it a 60% coverage basis on a shorter long-term disability policy off of 75,000 of your net income versus 60 to 70% of 300,000 of your gross revenue, which is technically what you need, right? Because that's, covering those bills. There are some additional components to short and long-term disability that you can help cover those expenses. That's a hole that we could go down here at a different point in time. But that's available. It's just for an additional cost. So from a business owner perspective, you got to be really careful and strategic there too.
Yep.
Yeah.
I think you tied it up pretty well.
Perfect.
3 different types of coverage: health, wealth, and income. It's really all.
And if you have any questions about your coverage or a coverage that we talked about that maybe you don't have, and you're looking to maybe get started, please feel free, reach out to Kyle or myself. We'd love to talk to you guys. Thank you so much for listening, and we'll see you on the next episode.